Uh, to those participants and uh, folks that we have on board so far, welcome to the Can I Make Money? How to Build a Financial Pro Forma Forecast for the Minnesota Score chapter. Uh, during this during this webinar, we'll be discussing how you can go about financially planning and forecasting your income, revenue, expenses, all the sorts of things that you're going to need to do, uh, whether you are already in business or you're starting a business. It's vitally important that you go through this process to plan your business. It's a vital part of your business plan. We have some really great speakers today, Steve Rogers and Joe Anziano, who are very experienced in doing this. We're going to try to keep it as high level as possible and simple for you to understand, because we understand that most people have not had the benefit of multiple accounting classes and or business planning courses. So we'll keep this as simple as we can, and hopefully you can understand it. From a housekeeping perspective, if you have questions, we have all of the participants muted. There's a On the bottom of your Zoom screen, there's a Q&A section where you can type in the question whenever you like during the webinar. I'd encourage you to please do so. We would like to have interaction with you as we go through this. At the very end of the meeting, Janae will be, who is our proctor, will be helping us go through the questions one by one, and we will answer every question you have. Even during the Q&A session, if any other questions come to mind, feel free to please type them in, because this webinar is for you, the participants. Most of us presenting understand most of this stuff. The important thing is that you get the most out of this webinar as you possibly can to help you run your business. Okay, next slide, Steve, please. So let me tell you, my name is Tom Garove. I'm one of the co-chairs for the education and training chapter for our Minnesota chapter here in Minnesota, which is our SCORE chapter here, Minnesota, meaning we support both the Manatee County and the Sarasota counties for SCORE. A little background on who SCORE is, if you're not familiar with us. We're a nationwide nonprofit organization as part of the SBA. All of our members are volunteers. This service is free of charge, and it's particularly, we're finding that we're becoming more and more busy with the COVID pandemic that's going on, and all the needs that small businesses have to help get through this difficult period that we're in, and hopefully that's the role we're playing. As you see on the screen there, we offer free, and that's important, confidential business mentoring and education, and we hold workshops and trainings such as the one you're attending throughout the entire year. I'd encourage you, if you haven't already done so, go to our website and you'll see a complete library on all the different topics we have, and we're always adding to it as we go through it. We are really big, as that slide says, 300 chapters nationwide, 10,000 volunteers. We have roughly 90 volunteers here in the Sarasota Manatee chapter, our Minnesota chapter. The SCORE organization was established 54 years ago. SCORE standing for Service Corps of Retired Executives. They've gotten away from that designation, simply calling it SCORE. But as the title insinuates, we're a group of retired executives who are giving back to hopefully the communities in which we live, and providing a service to help you make the community better from a business environment. We assist over the history of SCOREs. They've assisted over 11 million U.S. businesses and clients. And our chapter, as the slide says, we were 2017 chapter of the year out of 300. An update on that, at 2020, we just were designated a platinum chapter, which we're very proud of, and that's based on internal metrics and ratings that we get from our clients. So we're pretty proud of the service that we give to our clients. Next slide. This is just to give you an example. We're obviously a nonprofit organization. We rely on donations from sponsors. As you can see the list of sponsors on the left-hand side of this screen. They're mostly local banks who, incidentally, also, if you're not familiar with the CARES Act and the PPP loans and EIDL loans, These banks are most helpful to the small business community. We encourage you to take a look at their services if you like. They're our sponsors. They make small donations, which help us finance different things of printings and managing our website and low little expenses that we have. We also have community partners that provide other kinds of support for us, as well as the Chambers of Commerce and Technical College, Manatee Technical. You can see all of the different partners that we have in the community. Next slide. So what do we do? From a business perspective, we help people with pre-startups. We do help you do research and planning if you just have an idea for a business and you're just getting started. That's a significant number of the clients that we have. We also will help you through the startup phases and opening. We even work with businesses that have been in business for a year or more. If they're looking to grow their business, if they're looking for assistance and some kind of mentoring on how to grow their business, we have a lot of our mentors who can assist in that area, as well as all the way to closing and selling your business. Surprisingly, there's a lot of business people that when they get to the end of their career and they're looking to cash out of the assets of their business, it's not always an easy task and requires a lot of thought and planning, and we even provide that service. So you can see we go all the way from the startup phase all the way to the complete closing of a business if necessary, and we have all the services to go along with that. And once again, it's free, personalized, confidential, and we typically assign one mentor per client, and then that mentor acts as the prime mentor for you. And if there's different skills or knowledge sets that you may need in your needs for your business, that person will bring those resources to bear to assist you. So that in a nutshell is what we do. We're going to get on to the topic now. I'm going to turn the meeting over. Just one other quick slide. Quickly, the concept that we do with our clients, just so you're aware, is our business model canvas. And if you're exposed to SCORE, you'll hear more about how our business model canvas works. It's a 9-step process in planning and thinking through your business. That's an ongoing living process that we do through our mentoring, through our live workshops, and then 24-hour online podcasts and webinars. All of them are surrounded and really tie into our business model canvas. And that business model canvas is the roadmap and different skills and knowledge sets that you need to run a business efficiently. So you'll hear a lot of references to the business model canvas from all of our presenters. And I encourage you, if you have not already learned about the business model canvas, please take the time to study it a little bit as you get more and more involved in SCORE, because it's without a doubt the best road path that you can follow in thinking through and planning your business. So next slide.
Okay,
so,
Tom.
Right now I'm going to turn it over to Steve, who's going to launch us. And Steve Rogers, you're on.
Thank you, Tom. Thank you, everyone, for attending. This may be a little too fast for you in the time we have available, but the point is we want to make you aware of the help we can give you. We're always available if you would like to sign up with a mentor and get some very personal help, especially from myself and from Joe. This slide is a summary of the business model canvas, as mentioned by Tom. It has 9 segments in it, and the pro forma covers the last 2 segments at the bottom there. What will it cost and how much will you make? So if you are already a member or already working with a SCORE mentor, you've probably already seen this. If you haven't, then you can sign up with a mentor and you can get free help from SCORE to put this together. The actual BMC requires a lot of homework. I highly recommend you complete the first 7 sections of the business model canvas before you start work on the pro forma. The pro forma will require a lot of background information before it's completed. So let's get some definitions out of the way first. The pro forma is not a formal financial statement. A financial statement is a very scary thing. It's a set of business financial results that have to follow generally accepted accounting principles. It is something that records history. It is made up of an income statement, a balance sheet, and a cash flow, and it covers historical facts. If you understand how to read a financial statement, it will show you trends of your performance historically. And SCORE has a workshop that covers that called Am I Making Money? Teaches you how to read a financial statement. A pro forma is just a Latin word for as a matter of form. It's just a plan, and it's your plan, and it doesn't have to meet any accounting rules. You need a CPA to produce a financial statement. You do not need a CPA to produce a pro forma. In fact, a pro forma makes a lot of CPAs cringe because it has no real rules. It's your vision of your business and how you intend to implement it. The complexity, though, can be a little daunting. But if you get yourselves a SCORE mentor and they provide the assistance of myself or Joe, we will help you put one together. It's not scary once you get some help. So why would you need a pro forma? If you're starting a new business and you want some money from the bank, they will ask for pro forma, because a pro forma shows how much money you will need to spend before you open the doors of your business. If you're a new business, it will show you how long it takes to start making money, and it will show you which products and services will make you most successful. If you're buying a business, the historical results are in the financial statements that you can read. But if you need to analyze how to build the business better and build on the strengths and eliminate the weaknesses, you will need a forward-looking plan, financial plan, which is a pro forma. If you have an existing business, you might want to change your business model to make more profit, or you may want to do some scenario planning in times of uncertainty, and we are now in times of uncertainty. So a pro forma can let you play with the financial numbers, and I use the term play generously, but it is an opportunity to move numbers around and see what benefits you. And again, as I said, if you want to go to a lender or an investor for money, they will want to see your pro forma before they will even talk to you. And it demonstrates that you are driving the business. Your pro forma shows how you intend to drive the business, in what direction. You don't want to let the business drive you in front of a banker. So your pro forma is your forecast of expected results when you execute your business plan. And it must be built on reality, not on a dream. The more reality is in your plan, the less chance of failure. If the reality in the plan shows that this is not going to be successful, maybe you should not even start. So before we go any further, I want to make a few points, like cash is king. When you're running a business, cash is king. If you don't have any money in the bank, you can't make payroll. If you can't make payroll, the business will fail. If you're going to a bank to borrow money, a bank needs 2 years of tax returns before it will lend to you. If you're a new business, suppliers will not extend credit until they see you successful. So when you're starting up a business, don't expect to get 30-day terms or 60-day terms from your suppliers. They will ask for a credit card number or a check before they'll ship anything you need to start your business. Capital is a term for a financial asset. So when anyone refers to the term capital, it's the cash, it's the line of credit, it's the equipment you own or have in the business. That is a definition of capital. It's a financial asset. And working capital is the assets working for you. An investment in your business is working capital. So please remember, when you're looking at launching a business and you prepare a pro forma, it will tell you if you're going to make money or not. And if your business is not going to make money, more money than your bank account, then don't even start. So here's what a pro forma looks like. It's a spreadsheet. And this is where it gets scary, because this is the summary page of the spreadsheet. Behind this are many other worksheets. The worksheets feed this summary, and this is where people get into trouble. If you aren't a spreadsheet savvy person, we can help you. If you want to take any courses online on how to use Excel spreadsheets, it would be very advisable, because this one page is what you want to put in front of a lender or an investor. And this one page comes from many other pages behind it. And constructing these pages to present a pro forma is what we can help you do. What I'm going to do, sorry, I'm going to go back 1 second. The periods along the top are, in this case, months. So this is a 12-month forecast pro forma. The column down the left side are the lines you need to work out, as I said, from the background sheets. So what I'm going to do is go down the left column one at a time and explain what needs to be accounted for in each of these items: sales, cost of sales, margin, etc. As I said, it's very hard to cover everything in a short presentation like this. So as a follow-up, you can ask questions at the end of this presentation, and you can contact your SCORE chapter and have a meeting online or by Zoom or by telephone with myself or Joe to go into more detail. So let's look at these one at a time. At the top of the column is cash. If you're starting a new business, this is the resource you have at your fingertips today. It's your cash. It's the total amount of money you're willing to put on your credit cards. And it's other people's cash, such as friends and family that are trying to help you out here. And it's any bank line of credit. So this is the total amount of money at your disposal. Your cash has no penalty to it, but your credit cards, of course, have interest. Friends and family money, please, if you're borrowing from friends and family, they will want to see this. The bank will want to see this. At the start of a business, cash flows out, negative cash flow. You drain your resources. Later, as the business picks up, cash starts to flow in and you have positive cash flow. Getting from negative to positive is the challenge when you're starting a new business. I'm sorry, I'm going to go back again 1 step. The cash at the end of this column is how much you have left at the end of month 1. And that becomes the beginning cash of month 2. So the first line of the real pro forma here is the sales line. No sales, no business. If you can't figure out how to get the revenues, and we'll talk about that a little bit later, then it doesn't appear by magic. How will you set your price? How many products do you have? And how will you price each product individually? And that's where the background spreadsheet comes into play here. You have to look cumulatively at each product or service and what each one of those will generate in terms of sales revenue. Study your competition. You set your prices for your products based on the competition you face. Are you going to be a premium product and price your products and services higher than your competition? Or are you going to be the low entry? Are you going to try and drive everyone else out of business by lowballing your price? Are you a superior product or are you the lowest price competitor? Include here all the sales of all the products and services that you provide. Look at each individually, and this is very complex, and this might be where you need help if you're not an experienced Excel spreadsheet user. What are your assumptions about price? It changes over time. Somebody gives a sale, puts on a sale, it puts the pressure on you. Will you respond? Will you have discount sales yourself? Are the sales seasonal? Will you have, especially in the Sarasota area, will your business have more revenue in the winter than it does in the summer? What are the rational, logical assumptions you're making behind your sales numbers? Do you have any historical data as a basis? If you're buying a business, you can look at the financial statements from the past. If you make stuff, can you make enough? You cannot claim sales that are higher than your ability to make product. And do not include sales tax in these numbers. That goes into your bank account and goes straight back out again to the government. So it's not counted. The next line to look at is cost of sales. What are the costs associated with the products or services you sell? So this is the more complicated, probably more complicated part than the sales line. Cost of sales is made up of cost of goods sold, which we'll address on the next chart, and many others that could contribute to cost of sales, such as shipping costs. If you run an online store, do you provide free shipping or do you pay the shipping costs? If you have a business that has salespeople on commission, if you pay them 5% of the sales number, it's a cost of sale. This cost of sales line also includes items not sold. For example, day-old donuts or unsold Christmas cards. If you own a donut shop, you make 100 donuts and you sell 80, then you claim the revenue for 80, but you still have to include the cost of making 100, even if you throw 20 away or donate them. You still have to accommodate the costs, count the costs of everything you made but didn't sell. This line also, cost of sales, should include a reserve account, meaning you put money aside to pay for something in the future. For example, warranty repairs. If you sell toasters and you sell 100 toasters with a 1-year warranty and 10 toasters get returned because they broke, then you have to give another 10 toasters to those customers free. So you have a warranty charge you have to plan for. If you promise future updates to a product without revenue, you have to put money in an account to cover the cost of what you promised. Plus return goods. If somebody returns a good and wants a refund, then that's a cost of sale. So let's go back and look at cost of goods sold, because this is the major part of this cost of sales. The cost of goods sold, if labor is a variable, and this is where it gets a little complex, is the parts and labor to make the product. This is particularly relevant to if you're a manufacturing company. If you're making a widget that's got $50 worth of material in it and $10 worth of labor, then the cost of goods is the labor and the material it takes to make that product. The labor included in this cost of goods is just the labor dedicated to making it. Typically, in this kind of business, a variable labor business, you hire people and fire people as demand changes. In the good times, you hire people on to produce product, and in the bad times, you have to lay people off. This is all part of cost of goods sold, the labor and the material. If labor is fixed, then your labor is constant depending on demand. E.g., you may be, for example, a bakery or a pizza store. You've always got the guy who makes the pizza standing there waiting to make a pizza when the order comes in. You don't tell him to come in if you're expecting to sell some pizzas. That person is always there. And so that person is not part of the product cost. That person is an employee that we'll account for later. If you're someone else, if someone else makes what you sell, for example, Hallmark, you buy it in as a finished product. It's a birthday card, it's a picture frame, it's something that's fixed cost that you get from your supplier. You've no labor involved in the cost of goods sold. If you're a service business, the salary and benefits of the person providing the service is part of cost of goods sold, plus any consumed materials. If you're a landscaper, then the person that does the work plus the gasoline to get there and for the lawnmower is part of cost of goods sold. So if you're a massage parlor, massage oils plus the person providing the service. The next line is gross margin. So sales minus cost of sales is the gross margin in dollars. As a percentage, the gross margin is that number, margin divided by sales times 100. So we have two lines here. One is dollar margin, which is simply sales minus cost of sales. And the next one is gross margin in percentage terms. Now, why do you want to know this as a percentage? And we'll discuss that later on in a later slide, but the gross margin as a percentage is used to illustrate your improving margins over time, because margins do change over time. Competition can drive your prices down. If somebody moves in next door with a competitive product, they can cause you to reduce your prices to stay in business. If you want to introduce a premium product or a premium service at a higher price, you can improve your margins. Suppliers, if suppliers increase the cost of your materials, your margins will deteriorate. Gasoline can have a major impact on your margins because everyone that provides you with materials will raise their prices if the cost of gasoline goes up. So the one thing to remember here is set your prices according to what the market will bear. And then your costs of sales, you have to manage very carefully to make your margin as high as possible. Don't take your costs and just double them to create a price. People might not pay that price. They will pay what they think the value is for your product is. So going back now, we've looked at sales, cost of sales, and come up with a margin in dollars and percents. We now, that is the generating engine. The sales and the cost of sales generate the dollars. They generate the business dollars. But now you have to pay for some operating expenses. The operating expenses are the general and admin expenses, the sales and marketing expenses, and the research and development expenses. So these add up to operating expense. So now let's take a look at those three and see if your margin dollars are enough to fund the operating expenses. And it's key to know that the operating expenses are costs not directly involved in making or delivering the product and service. General and admin. This includes people not counted in cost of goods sold. These are management people, supervisors that don't physically get involved in making the product or are not accounted for in making the product. It includes your accountant, bookkeeper, people who clean and maintain your facility, secretarial and admin people. And it's not just their salaries, it includes their healthcare, benefits, payroll, taxes, etc. And does this include you? That's a question you need to ask. Are you including yourself in the management line? And are you going to pay yourself a salary out of general and admin? Other items to account for in general and admin are rent for your store, your factory, your warehouse, whatever business you're in. Do you have a rent payment every month? Do you pay utilities every month? Do you pay legal fees? Obviously not every month, but do you have legal issues that come up occasionally? Do you have a CPA to prepare your taxes, and how much do you pay the CPA? Telephone and broadband fees, insurance fees. Do you have to have a business liability insurance? Loan and interest payments. So if you have a line of credit or you've charged a lot of this business to your credit card, are you going to have to make monthly payments that should be put in here? Do you need licenses, certifications, permits to support the business you're in? Do you have property tax payments? There's a long list of other items here, and this is not exhaustive, but you have to capture it on a month-by-month basis. The next line is sales and marketing. So the business does not launch itself. You don't open the door and find people lining up to get in the door and buy your products or your services. So you have to put some money into generating that business. The sales and marketing section is all about how much you're spending to create buzz that creates people buying your products and services. Are you going to hire sales and service and marketing staff? Are you going to advertise? Are you going to give away teasers? Are you going to give away product? Are you going to give away some little gadgets that are like key fobs that have got your company name on? Do you have marketing materials, printed materials, business cards, etc.? Are you going to trade shows? If so, how much are you going to spend on trade shows? What's it cost to put up a booth at a trade show centered on your business? And if that trade show is out of state, what's the travel and living expense? Are you going to fly there? Are you going to stay in a hotel? What's it going to cost you in travel and living? Are you going to market through a website? Are you going to have the best website, the best search engine optimized website, so that if somebody's looking for your product, you will always pop up number one? Are you going to hire these people, or are you going to use consultants? Are you going to buy business reports? Are you going to subscribe to industry newsletters and magazines? So anything associated with getting the word out to get your business in front of the public and create demand, you have to put in on a monthly basis what you intend to spend on this line. Research and development. So this may sound a little strange to some of you, but this is where you capture the investment required to create a new product or service. You don't always need designers, engineers, fabricators, etc. But if you're intending to launch a new product and it takes some work to prepare and design and model that product, you should capture it in the R&D line. Does the arrival of a new product start a new revenue? Innovation is what keeps you ahead of the pack. Your competition will be innovating, so you have to stay with them. Reminds me of Subway. Subway used to just make sandwiches. And then along came Quiznos. Quiznos had toasted sandwiches. And so suddenly Subway saw their sales dropping because people wanted toasted sandwiches. So Subway developed their own instant toaster, looks like an oven. And I think they've almost put Quiznos out of business, but you're going to have to spend money innovating to keep you ahead of the competition. And anything you spend on that is captured in the R&D line. So now let's look at an example of how those numbers add up. Let's assume, just for this example, that you have resources, cash resources, whether it's cash or credit cards or a line of credit of $50,000. And in this period, you have $10,000 of sales. And your cost of sales happens to be $5,000. So you've made a gross margin of $5,000, 10,000 minus 5,000. And 5,000, when compared to a percentage of sales, is 50%. So in this particular example, you have a gross margin of $5,000, or a 50% margin if you express it that way. Then you have general and admin costs of $2,000 this month, sales and marketing costs of $1,000, R&D costs of $1,000. So your total operating expense is $4,000. So you started with cash of 50. You've earned gross margin dollars of 5, so that means you've got $55,000 now. But after you deduct the operating expense, you've got 4,000. Sorry, you've got 50,000 to start with, 55, including gross margin, minus 4,000. So you're back to 51,000, right? So although you have operating earnings now of $1,000, you haven't exactly made some money yet until you consider the last two lines, capital spending and inventory spend. So let's look at those two items. What is capital spending? If you've had to make any major purchases that have a life, then it's called capital investment. You don't need to worry about depreciation, which is a financial reporting requirement. All you have to worry about here is the cash you have to put out for a capital investment. And that includes things like real estate or equipment to keep up with sales, such as food prep equipment, manufacturing equipment, computers, construction and landscaping tools, vehicles, something large that lasts a long time is a capital spend in your business. It's better if you can, in the early stages of a business, to rent rather than buy. If you get into trouble, you can return rented equipment. And if you have bought equipment, you have to put it on the market to get rid of it, and no one wants to buy used equipment. If you've got a vehicle and you need to get rid of it, you're going to lose a ton of money on that vehicle. So in the early stages, renting, if possible, is the best. The next item is inventory. If you're starting a new business or introducing a new product, you have to build inventory of that new product. If you have purchased a business in trouble, you may have to junk the inventory if it's old and cannot be sold anymore. Some inventory expires, especially food products. If they've expired, it's a major expense to replace them. If you spend too much money on inventory, you've got cash tied up in a freezer or cash tied up in raw materials that you can't use. If you've overstocked, that cash is no longer available to you. So if we go back and look at this example, you had operating earnings of 1,000. Again, that was gross margin 5,000 minus the operating expenses, which were 4,000. So you've got operating earnings of 1,000. So that means you started with 50. You've got 1 left in operating earnings. So you now got 51. But if you have to spend capital of 5 and inventory of 2, you're now down to 44,000. So for your first month in this example, you were cash flow negative, which is not surprising when you're starting a new business. So now let's look at what a 6-month projection would look like, because here are the traps. Here's what happens. Most people starting a new business assume sales in month 1. Well, in this example, in month 1, there are no sales, because in month 1, you spent most of your money hiring people for general and administrative work. You've spent a lot of money, sales and marketing, getting a buzz for your products. So you've no revenue, no margin dollars, and $7,000 of operating expense. So now your operating earnings are -7. You've spent $10,000 on buying equipment for your pizza kitchen, whatever the business may be. You spent $3,000 ordering flour and cheese and whatever else you need to make pizzas. So now, after the first month, you spent 7, 10, and 3. So you've got 30,000 in cash before you've opened the doors. But hopefully the 6,000 you spent on sales and marketing pays off. And in month 2, you start to see revenue. Here's what usually happens. The sales ramp is usually slower than you hope for. Unfortunately, most people that start a new business are very optimistic about how fast they can grow sales. If you invest enough in sales and marketing for the first few months, you can drive the revenue up month after month after month. And if you focus on reducing your cost of sales, eliminating waste, eliminating returns, you can get your margin up in terms of a percentage. So in this illustration, we're showing the gross margin growing 40% up to 55% after 6 months. General and admin spending tends to stay flat because the managers, the supervisors, the admins, the bookkeepers, you really don't usually need to change that much. But over time, you can reduce your spending on sales and marketing. And after 5 or 6 months, you might start spending money on R&D to improve the products or introduce new products. So as you see in this illustration, you started with 50,000. By month 4, you had 9,800. By month 5, you had 5,300. By month 6, you had 3,300. But at the end of month 6, cash had gone up to 38. So you started to turn around and get cash flow positive. But how long can you sustain this? You started with 50,000. How long will it take your business to get back to 50,000 in cash? Because the question is, if your business can't get back to the 50, you may as well have just put the money in the bank, mutual funds, CDs. It's important that you continue this analysis to make sure that your investment gets paid back. It might take a year, it might take 2 years. You can extend this pro forma out as long as you want, as long as you're being realistic about the numbers. So the decisions you have to make. If you can make money, does it pay you what you want? Did you put a salary line in here for yourself? And did it return what you want to earn to make this worthwhile? Have you been brutally honest about these numbers? Can you respond to a competitive threat? If you start a successful business, somebody's going to notice and somebody's going to try and dethrone you. Someone is going to try and copy your business model and outsell you. Always, always, always think about the competition. That's all that really matters. There's an old joke I'll try and tell. It's always risky telling a joke online like this, but it's very old, and there are 2 hunters in the jungle, and the 2 of them come across a lion. First guy immediately takes off his boots and puts on his running shoes. The second guy turns to him and says, "You can't outrun a lion." And the first guy says, "No, but I can outrun you." So that's what competition's all about. It's the competition that you're up against. It's not the lion. Maintain your pro forma as a living document. Keep it current, correct it for errors and correct it for reality. Hope is not a strategy. Just hoping things will improve is not going to work. Take action based on what the pro forma is telling you. And if the pro forma says no, where is the biggest issue? Can you eliminate the biggest issue and turn around your business? In today's environment, a lot of businesses are suffering. We live in uncertain times. If you have a pro forma as a living document, you can take a look at changing prices, changing volume, reducing product costs, eliminating low margin products. Would a new product be better? Where can I reduce operating costs? Most importantly, when will my cash run out? How do I outlast the competition? So with a working pro forma, you can try different scenarios. And each one of those will give you an answer you may or may not like, but you have to be able to look at taking different steps to make sure you can succeed through what we're all experiencing right now. Finally, I have to say that there's a lot of details that need to go behind each of the lines on this summary spreadsheet. Every business is different. There's no such thing as an Excel file that can capture every different business. Each line on the pro forma needs a worksheet, and everyone's sales, everyone's costs, everyone's plans are different. So no single solution fits all. So ask your mentor for help. Myself and Joe are available, and Joe's now going to take over and take control of this presentation and give you an example of the workings of a spreadsheet. Are you ready, Joe?
Yeah, I am. Let's see, how do you give me back the screen? Let's see, if I go to show you want to say yes. And let's see. Okay. So what you see here is basically pro forma that I'm going to walk you through. So as Steve, you really summed things up a lot, and very well done. So pro forma is a pretty complex beast. When I first started my business 15 years ago, I started as a franchise because I did not know anything about business, and they threw this thing at me, pro forma. And I said, oh yeah, I play with all these numbers. Well, I moved the numbers around on the spreadsheet to the point where I was making $1 million a year. 6 months later, I was in business, and suddenly, wasn't finding that kind of cash flow. I will tell you that after 2 years, I bankrupted. I wish I had known about a pro forma back then, and needless to say, I didn't. So we've all learned a lot being through the war. So what I'm going to walk you through now is I've built this pro forma in 2 separate sheets because I've tried to capture everything. This is the basics. And what I do when I'm working on a pro forma is I start with the fixed costs. First, this number here, cash at beginning. This is what I have in my checking account. This is actual cash that I have in the checking account that I'm going to start working with. So let's assume I have $25,000 cash. Okay, we'll do that. So now I'm going to come over to the administrative costs, and you'll see a lot of things that Steve just said. Hey, I've got a certification fee, maybe a business fee, a legal fee, maybe $1,000 at the beginning to start, researching some of the legal issues. I got accounting fee, $500 a quarter, and at the end of the year, I pay $1,000 into my tax return. You might have some office supplies that get thrown in here. You've got office equipment, think printers, your toners and paper and whatever you may be using on a day-to-day basis, staples and all that kind of fun stuff. And then I said, okay, hey, I want to pay myself something. So I want to pay myself $5,000 a month. So we throw that in. So $5,000 a month, it's a $60,000 salary. That sounds good. And I've got some people that work for me, and I'm going to pay a total payroll out of whatever you calculate that out. I threw in an example of $2,000 on payroll, one or two people, you customize it. Oh, by the way, you have to pay payroll taxes. The share of that comes out of your business. So that's an expense that you got to calculate in. We've got rent, we've got utilities, all this fun stuff. So, you know, you're going to be generous in contributions. All this stuff comes out of the business. You're going to want to know this on your income tax, because at the end of the year, you know, you want to show a profit or a loss, and then you want to pay or not pay taxes based on that. Equipment capitalized. Let's say that's what we'll talk about this a little bit later. But here's leased equipment. Maybe you lease a printer. Maybe you lease, you know, as Steve said, you don't buy all the equipment, so maybe you lease it. No, that's an expense that adds up. So that's your admin costs. The next thing I do is I look at my marketing. I've got social media. Maybe I'm doing some pay-per-click marketing. I've got a website. I pay someone to maintain my SEO. Maybe I do some print marketing. Maybe we have business cards. We do some brochures, rack cards, hand them out, giveaways to people, put them in stores. Maybe you do direct mail. Maybe you do radio, TV, giveaways. You know, promo items. You're gonna, you know, those things. I didn't put any in this example, but you need to take it into account. Maybe you're going to do some radio advertising. Maybe you do some this. Maybe you do some that. Up here, I have trade shows. You want to keep track of what you spend with the trade show fees, travel, hotel, food, client meetings. You're gonna wine and dine some clients. You're gonna take them out to dinner. You're gonna, you know, whatever. These are things that you need to put in here. If you do network marketing, one of the best things I did to market my group was a network group called BNI, Business Networks International. It costs $1,000 a year as part of that, but it grew my business. So, you know, I had to put that in there. So you get all those. He talked about R&D. You know, you can throw that all in. And at the end, so I come up with my, here's my three biggies. These are the fixed costs of that business. These are the things I pay on a monthly basis, month to month, whether I sell product or not. Not variable costs at all. I have to pay the rent. You know, the landlord doesn't matter. Doesn't care. I have to lease equipment. I have to do this. They don't care how much you're making. You have to pay that. So we put all that in. Okay. So now, so we got our fixed costs. So now I want to work on my product pricing, because those are your big knobs. The fixed costs you really can't control. You know, they're part of your business. So now I got a product. So I take my average monthly fixed costs, and in this case, I threw in some starting inventory. And now I get to work on my products. Well, I've got, in this example, I've got 11 different products. This is a, you know, piece of business. You know, it could be software. I've used this on a variety of businesses. It could be online, doesn't matter. You got different products, and each product has pieces that go into it. In this case, pizza, I got to account for flour. It could be, packaging. There's going to be packaging, whether you're shipping out of eBay or whatnot, it's got to be packaged. There may be an eBay fee in here if that's what you're going to do, and there may be a shipping fee. If you're online business, each product has its own shipping fee. In this case, I say, hey, listen, I got to assemble all this stuff every time someone walks in the door, and it takes me 1.2 units of labor to do that. No, that's a price. So let's say it costs me 1.1 hour per piece let's say I did 600 that month. That means I've got 60 hours to account for. We'll use that later on. We want to know if we've actually got enough people on board to operate this business. So you go through each product and you fill that all out. So now, like I said, we've figured out our average monthly fixed cost. We've got all our products. And hey, now we can go to our dashboard. Here's where we have fun. Let's say I said I wanted to make $5,000. I had a revenue goal. And let's say I said, hey, how about copy? Let me not do that yet. We've got success. So what I'm doing is what I'm playing with for each product, how many I'm going to sell in a month and what I'm going to charge for that, because I've already fixed my costs in here. So I did the cost for each one. So, and that cost comes here. It says, hey, for this product, my cost is $2.29 each. If I sell 600 at 700, I got a profit there. And in this particular case, I had success. I started with this set of data. I started 5.5, 7, and I didn't. So I said, well, maybe I could charge $7 instead of 5.5, and maybe this, and so we get that. So I take my quantity and price, and I go back to, oops, where am I? Share screen, your shares. Oh boy, now I've lost. Multi-properties, okay. All right, so now I'm gonna expand this all. Unhide. And I've gone into my product costs, and I've gone into my product sales, and I've copied some prices over here. These are more, and I said, here's my 12-month, here's where I want to be at the end of the year, but over the year, I'm not going to start out, as Steve said, in month one, I'm not going to be at $600, 600 units a month. So I'm going to start at 75. And in this model, I show an increase of 10% in quantity sales per month. It might be accurate. That might be wishful thinking. I might only sell 25, but this is my model, okay? Remember, we're planning here. We're trying to see what this does. So I go back to my pro forma, and I started with 25,000 cash, and all of a sudden I start to notice that my cash flow is negative. And, my bank account goes negative a couple of times. Hey, at this month, I'm $20,000 in the hole. That's not good. So I need to then go to my line of credit. And let's see, I've got a 10,000, maybe, I don't know where this cash is coming from. Maybe I used, in my business, I used a HELOC. Line of credit for my home. And so in this case, I said, well, maybe I better throw, maybe I better throw another 4,000 in over here. So you start, this is cash that you're putting into the business, and you got to pay it back somehow, somewhere it's going to go. And you can then go back to your pro forma and said, well, that's got me a little bit better, but I'm minus here. So how are you going to make up for that? Maybe you're going to go back to your products, you go back to your product sales and say, well, you know what? $7 ain't gonna cut it. I better raise my price to $8. Can I sell that? I don't know. When I started my business was a printing business. And I set prices based on what I wanted to sell it for. What I started to notice is that I put bids out. I had people come in and I gave them quotes on that price. And I started to notice that I was only winning 25% of the orders. That ain't gonna cut it. So now, we start to say, well, so you start calling around business to business, you check your competition and say, well, I can't sell that product for $10. They're selling it for $5. Okay. So do I need to increase? These are the buttons you get to play with: your price and your quantity. Price and quantity. So I either increase my sales or I increase my price. These are the things that you get to play with. On this, now my inventory is on another sheet. But I also, in this case, I had to work with, that's the other thing I said, well, maybe I can't pay myself $5,000 a month. Maybe I'll cut myself down to $1,000 a couple of months and ramp that up. And, so I said, okay, well, no, not 200, sorry, we ain't doing 200. And we start seeing what that does to the pro forma. And I was staying positive. Okay, but I'm only paying myself, so I cut my salary to do that. That an acceptable answer? You get to decide. But these are the knobs that you get to play with. The biggest knobs you're going to find are right here: the quantity and price. And that's what you're going to have to do. And you're going to have to go and work through the numbers. This is not easy stuff. This is stuff that takes a lot of thought. If I go to my, some of the things I consider, where do I pay? I assume that in all of these, I'm assuming that I'm paying cash for my operating funds, and I'm using credit for capital equipment. You need to decide how you're going to handle that. You need to work on your labor costs, whether you're going to figure them as fixed or variable. That's a decision that you have to make. And we have 4-week months and 5-week months. So you get to play with a little bit of that. What this all comes down to is it's worth spending time doing this before you start the business, to start and do the calculations, maybe I'm not going to, let's see, maybe I'm not going to, how many, when I first opened the door, how many am I going to really sell a month? Maybe I only sell 25 of these. And maybe I only, the first month, people don't even know I exist. And that starts to play with the numbers. So you need to work with someone that's gone through this before and help you. It's all these negative numbers start coming up. Loss. Start making money at the end of the year. In this very optimistic model, but don't forget, you're not paying yourself either. So this, is this realistic? Work with your mentor. There's a lot of knobs to play in here. You've got, you might have expenses that we haven't even covered. Some businesses don't have some of these expenses, and maybe the model simplifies. But the worst thing you can do is just guess and overlook something. Like I said, I ran out of cash after 2 years. I had to close the shop. I watched vendors repossessing all the equipment I was leasing. They just take it right out, and there goes that money that you just spent. So what I suggest is contact SCORE. Let us work with you. Get a mentor. Let the mentor sit and work through the numbers. What numbers apply to you, and how the cash flow works, how your credit works. I calculate on here what your debt load is. And maybe 25, maybe you don't have 25,000 to start. Suppose you only have 5,000 cash to start. Whoa, I see a lot of negatives. So work with your mentor, get the pro forma done properly. They can help you ask the right questions and answer them in the right way that makes sense. And that's as much detail. You've seen a lot of spreadsheets. That's a lot of details. So how are we doing? Do we have any questions?
Hi, Joe. We don't have any questions right now, but if any participants want to ask anything, they can go to the Q&A button at the bottom of their screen and just type something in, and we will answer it shortly. I also want to quickly start a poll. We only have a few people in attendance, but if they can.
Oh, I see there's an attendee poll. Okay. I don't see any questions coming in.
Okay. We have a few attendees have answered the poll, so thank you very much. Once again, just in a wrap up, as Steve and Joe have advised, you know, your mentor will help you. Either they can personally help you walk through one of these, an example for your business, or you can that person will reach out to either Steve or Joe to assist if need be. Once again, we highly recommend that whether you're just starting a business or you're even in business, this is a constant business practice that should be part of your annual, if not even more frequent, planning process, perhaps even on a monthly basis, that you revise this on a monthly basis to make sure that you're on track for your business goals, and that you're thinking from a realistic perspective. Can I make money?
That's an important point. The going back, one thing that I wish that I had when I had started this, if I had that spreadsheet and this spreadsheet all worked out that, hey, this is my plan, and if I'm not seeing that, where I should have gone back and plugged in actual numbers for the first couple of months and watched what was really going on. That's the power of this. If you make a predictive model and you get it to where your cash flow looks good, and 2, 3, 4 months down the line say, wait a minute, I'm not there. Here's where you can do it on paper, and here's where you can do the analysis and track, why am I not there, and what buttons and knobs do I need to tweak. So important. So important.
Absolutely. One other last best practice to think about. As you notice, Steve and Joe put together a monthly forecast. My experiences with car dealerships, and the best car dealerships that I experienced in my years with General Motors, I saw the best dealers and the best financial performance were those that actually kept a daily sheet where they looked at their actual forecast on their pro forma. They knew that they were trying to sell 25 or 30 or 50 cars per month, whatever that number was. And they also knew that they wanted to write so many service tickets in their service line. They had all of these numbers in their head, and then they were presented to them by their accountant on a daily basis that looked at what was the performance day by day by day to get to that final month performance number that's on that pro forma statement. Those were the best performing dealers. And typically what they did is if they weren't making their numbers, they were having management meetings with all of their employees and everybody on their team to make sure that it was happening. And if they didn't perform at the end of the month, there'd be discussions on should we revise our forecast for the next month? What do we do? How do we improve it, either in sales and or reducing our expenses? And they looked at every line item, typically almost on a daily basis. And we would strongly suggest that you think about that in your particular business. Yes, it's a lot of detail, but it's your money, it's your business, and the more you pay attention to it, the more likely you will succeed as a business person.
Sure, you could take this, just because we had 12 columns, you could take this and make it 30 or 31 columns and get into the detail and then roll it up onto the.
Absolutely. Absolutely,
Yep.
Joe. Anything to add, Steve?
No, I hope that was helpful to everyone attending, and I'm happy to help people if they want to call me. But please don't call me directly. Get yourselves a mentor, and the mentor will then contact me to come and help you.
You know,
Okay.
I look forward. I've done this for a number of businesses. We've adapted it to, there's all kinds of business models. No one model fits every business.
Correct.
And that's the magic. It's, oh, I don't have inventory, but I have eBay. You know, not one size fits all. That's where a mentor really comes in and helps.
Yep. Yep. Okay. Thanks, everyone.
All right, thanks.
No more questions. Thanks, Joe and Steve. Thank you, Janae. This wraps it up.
All right.
Everyone.
Yeah.
Have a great evening.
Goodbye.
Bye-bye.